On impact theory, Andrei Jikh laid out a thesis about Japan that should terrify anyone with a retirement account. Japan built the global financial system's foundation on free money. That money is being called home. Jikh's argument goes like this. After Japan's 1989 bubble burst, they spent 3 decades with zero interest rates trying to spark inflation. It never came. So money became free to borrow. The entire world took advantage. Hedge funds, banks, investors borrowed yen at 0%, converted it to dollars, and bought anything that paid more than zero. U.S. treasuries, tech stocks, Bitcoin, trillions of dollars of global assets, all partially funded by borrowed Japanese money. Jikh explains why Japan could carry 200% debt to GDP without collapsing. The borrowed money left Japan. It didn't compete for local goods, so no domestic inflation. And the debt was owned by Japanese institutions, not skittish foreigners. No panic selling. The system held. Tom Bilyeu, the host, pushes a critical addition. He argues the real driver is psychology. Japan's economy is a reflection of collective fear. After the 1989 crash burned an entire generation, Japanese savers stopped taking risks. The carry trade wasn't just a financial mechanism. It was the behavioral expression of a traumatized culture seeking returns anywhere but home. But here is where the story breaks open. COVID changed everything. Global money printing finally delivered Japan the inflation it couldn't create for 30 years. Wages started rising. Workers demanded pay raises for the first time in a generation. Once prices and wages start chasing each other, the genie doesn't go back in the bottle. So Japan raised rates, and they hit a wall. Jikh says Japan must choose between saving its currency or saving its bond market. Keep rates at zero and the yen collapses, destroying a nation of savers. Raise rates and the 200% debt to GDP starts accruing real interest, crushing the bond market. They tried a middle path. Small rate hikes plus $73 billion in currency intervention. The yen kept falling. Bond yields kept rising. Both markets broke at once. Now, here is what Jikh gets right and what he misses. He is right that the carry trade unwinding is the most underpriced risk in global finance. He is right that Japan's binary choice is real and painful. And he is right that most American investors have no idea their portfolio has hidden exposure to Japanese monetary policy. But Jikh's explanation for why Japan survived 200% debt is incomplete. The carry trade explains maybe 40% of it. The other 60% is demographics. Japan's population has been shrinking since 2008. Fewer people consume less. Less consumption means less demand. Less demand means deflationary pressure. Japan didn't avoid inflation because money left the country. Japan avoided inflation because its population is contracting. That is a structural force no central bank can override. And nobody on this episode mentions the word demographics once. There is a deeper problem with the binary framing. Save the currency or save the bonds. That assumes Japan cannot grow. But growth is the third option Jikh dismisses too quickly. If Japan generated real economic growth, stronger GDP would support both the yen and the debt service simultaneously. The binary only holds if you accept permanent stagnation. Tom Bilyeu hints at this when he says the hardest thing in the economic universe is creating a real risk-adjusted return. He is right. But that is the actual problem. The currency versus bonds framing is a symptom. The disease is Japan's inability to generate growth, and the historical pattern Jikh cites. Every yen spike corresponded with a global crisis. 1998, 2008, 2020, 2024. He says this time is different because Japan is doing it on purpose. But the correlation cuts the other way. Those crises caused the yen spikes. The yen didn't cause the crises. A deliberate managed repatriation over years is not the same as a panic unwind in 3 days. The real danger isn't the yen strengthening. It is what happens to U.S. Treasury demand. Japan was the most reliable buyer of U.S. debt for 30 years. If they stop buying and China keeps selling, who buys $9 trillion of rollover debt? That is the question that should keep Janet Yellen awake. Jikh's most useful insight is the stablecoin angle. Japan passed its own Crypto Clarity Act. Japanese stablecoins backed by government bonds would create a new buyer for Japanese debt, the same way Tether became one of the largest holders of U.S. treasuries. That is clever. It is financial engineering dressed as innovation. But it only works if global crypto markets keep growing. Another dependency on external demand. Here is the bottom line. Jikh identified the right problem. Japanese money is coming home. The carry trade is unwinding. American portfolios are exposed. But he underweighted the two things that matter most. Demographics explain why Japan's deflation was never a policy choice. It was a population curve, and growth, not currency management, is the only real escape from the debt trap. Japan does not need to choose between its currency and its bonds. It needs to become a country where money wants to stay. That's Andrei Jikh on impact theory. If you want the full 54 minutes, the link is in the comments. Rockport out.